welcome to Looking at the Markets with David Modell. Today's topic is Options Greeks Explained. What is Delta? So let's talk about that. Here's a question I was recently asked. I have been studying options. If I buy a call option and the expiration date hits, and the stock is up $1, will I get the $1 per share, or do I have to buy the stock shares and then sell them? So here's my answer to that. You can sell your options at any time before expiration. In fact, I almost never let expiration happen, since I don't really want to own 100 shares of the stock. That's what each options contract represents, 100 shares of stock. That would be a whole lot of stock shares to own, especially if it's an expensive stock such as Amazon, Google, etc. If the stock is up $1, then if expiration is going to happen very soon, the call option will be up almost $1, like maybe 75 cents or 85 or 90 cents, and you can sell the call option and get almost as much profit as someone who had bought 100 shares of the stock. And you would have done this with much less money invested and therefore much less risk. The closer in time you get to expiration, the closer financially to $1 profit you'll get if the stock is up $1. If there are a lot of days left until expiration, then if you sell your call option, you might only get 30 cents or 40 or 50 cents if the stock moved up $1. But that's still not too bad, especially if you don't feel like waiting. Waiting involves risk. The stock could go down and lose that $1 gain and more. On your broker's platform, see if you can find the delta of the call option you're looking at. The delta is the amount that the call option will increase if the stock increases by $1. For example, if the delta is 0.56 or 56 cents, then that means the option goes up 56 cents if the stock goes up by $1. The delta usually tends to gradually increase, all other things being equal, as we get closer in time to expiration. If you bought a put option instead of a call option, then the delta will be a negative number, but it still works in a similar way. For example, if the delta on your put option is negative 0.43, then that means for every $1 the stock goes down, your put option will go up by 43 cents. So, delta by definition is the amount that an option's price will move given a $1 move in the underlying asset's price. However, delta may also have a second use. Some people will say that the delta is also a pretty good rough estimate of the probability that an option will be in the money at expiration. For example, if a call option has a delta of 0.67, then you might expect that there's a 67% likelihood that your call option will, upon expiration, be at least 1 cent in the money. However, this would only be a rough estimate of the probability and is not perfectly reliable. So, I hope this was a thorough explanation of delta. There's more to delta than this, and I only gave a couple of examples, but this should be a good starting point for your study of delta and of options Greeks. If you'd like some more help with options, stocks, options Greeks, or just explaining things in stocks and options and finance in general, I'll be glad to help you. You can email me at any time. My email address is davidmodell@gmail.com, and that's davidmoadel@gmail.com. If you like this video, please give it a thumbs up on YouTube, and also leave comments. I really appreciate your comments. And also please subscribe to my YouTube channel, because that's how you can receive the latest updates on my financial educational content. Thank you so much for watching and listening, and I'll talk to you soon.